Gerhard Massenbauer has over 25 years of experience delivering macro investment strategy advice to investors and corporate treasuries around the world. From his base in Vienna, Gerhard has developed a reputation as one of the top FX and capital markets analysts in Europe. His insights are piercing, and he doesn't hold back from putting strong and sometimes out of consensus views into the market. That makes him a great fit for the Rosenberg Roundup, and we're excited to bring him on to discuss and debate some of his big calls. Gerhard, thanks so much for joining us on the Rosenberg Roundup. You have something of a unique global perspective from a European base, so we're looking forward to getting your views on a range of issues. And let's start in Europe. We've been covering the slowdown and the weak growth story there. We've written about Germany and how important it is as a primary impulse for European growth more broadly. And we're seeing a big manufacturing slowdown still underway on the continent. So my question to you is, what is your assessment of the broader European economy? What do you think the trajectory is? And most importantly, where do you see value in European assets?
Okay, thank you for having me. I would say we have a situation more comparably to the time before the financial crisis. We do have money flows within Europe coming from the EU programs for rebalancing the economy, which mostly flows to the southern area of Europe. So which means Italy, Spain, Portugal, also France do comparatively well. We did not have over the entire European economy a kind of recession we face in the center of Europe, which is Germany, you mentioned, Austria, also in the parts of CEE. The economy was very weak, but we see right now that things are going better. Even in Germany, we had some positive signals from the manufacturing side. And this is more or less the result of things happening in Asia, where you see in Taiwan and South Korea things improving. And the European economy is quite more dependent on international trade than the US or Canadian economy are. So this is some kind of at least relief of it. So I'm not very optimistic about growth in Europe because we do not have that environment we see in the US, where you have a huge fiscal deficit running into the economy, running also somehow into the stock market and into consumption. So this is what we lack in Europe. We are not that flowed by fiscal support, as you can see it over there.
And to me, that inability to coordinate fiscal support for the economy and, especially in places like Germany where fiscal rules put a very strict limit on how much cyclical support can be given. To me, that makes the job of the ECB even more important, right? It puts more leverage on monetary policy or puts more of a burden on monetary policy. So how do you see the rate outlook evolving for the ECB? I mean, we have this theme of kind of global cutting ahead of the Fed. Do you think, in addition to starting earlier, do you think there are much deeper cuts coming from the ECB?
I expect the ECB to start earlier than the Fed. I don't think the cuts will go deep as long as the Fed does not move, really. What we have is a divergence in the development of inflation rates. We saw in the last few weeks a spike in inflation in the United States. We did not see that, at least yet, in Europe. And the ECB is much closer to the 2% goal of inflation, as well as for CPI as for core inflation. So the ability to support the economy from the central bank side is true, much more given than the United States. Actually, Powell has to be reluctant seeing the current development, which can be viewed in different ways, as I know. But Madame Lagarde has the opportunity to lower the rates once or twice. I don't see that opportunity in the short run in the United States. So to rate cuts I would expect in Europe, one in summer, one in autumn. And then they have to wait what will happen in the United States, I suppose. So if there is some kind of movement into a recession or a weakening in the economy, there's some rebalancing possible at least. So we'll see.
Very interesting, Gerhard. Thanks. It's been a little while since I covered Europe closely, but back when I was looking at it, the ECB was by far the main driver of the government bond yield environment, and it was playing a big role in propping up the periphery, especially in preventing outright yield blowouts in those countries which were experiencing very high debt and also low growth. And since then, we've seen a big improvement on the periphery, especially in countries like Greece and Portugal. So my question to you at this point is, what's the update there? What's the status? And what do you particularly like in terms of the bond market in Europe?
Well, I would say it may come as a surprise that Europe managed its debt problem 10 years ago. And this was mainly due to the support of Mr. Draghi and his whatever it takes approach, which the markets believed it would be, whatever it takes to be done. I think the big difference between Europe and the United States is that Europe kept and even lowered a little bit its ratio of debt to GDP, while the United States doubled it in the last 10 years. So this is why we had much less investment in Europe, which is why we had much less GDP growth in Europe. And even though Italy remained on a very high level of GDP debt, right now the US is right at the same level, around 132 GDP. Still, the Italians, as the Americans, are very rich in the private sector. So I don't see that Italy itself is such a problem for itself or Europe. Greece, as you mentioned, recovered quite good in the last 10 years from absurd relations to quite elevated relations to have debt services. I'm pretty confident that Greece is going to make some more progress in the next years, as well as Spain, which is remarkably reluctant to the problem in itself. They're searching workforce. Meanwhile, they don't have a 20% labor force in the youth sector lacking a job anymore. The opposite is going on. My main concern in Europe is France. It's much more in expanding its debt, and even the companies are quite willing to, have been quite willing to increase their investments. So, which is why France in the last 10 years did a comparably good job in the increase of GDP, and attracted a lot of money also for the banking sector. So this helped, but it also lifted vulnerabilities that might come up in the next 10 years or something. We're close to that. We have discussions in Europe about the debt level in France, which, as I said, is increasing, and meanwhile above a level that is seen as healthy.
And what about Germany?
Germany and Austria as well. Well, we had a technical recession in the last few quarters, around minus 0.2, minus 0.3 or something. But if you look deeper, there's one point we might take into consideration that might shift the view a little bit. I know that in the United States, the property market was, except the CRE part, quite stable in an area of prices very highly elevated. I do know that in Canada, the property market was absurdly expensive a few months ago, and a little bit got a kind of correction, I believe 10 to 15% or something.
Yeah, still quite small.
And the price levels in Germany went down about 30 to 40% in the private sector. which is quite huge, and correct regarding to the development of the interest rates. The property market prices went up like hell when interest rates went down, and they did not fall at all in the United States, even increased in some parts. They corrected a little in Canada, and they corrected quite heavily in Germany, not so much in Austria. But if you take it into account that the property sector of the entire common economy is around 15%, and you withdraw 20%, let's say, of returns in that sector, you have -3. So if you take that into account, the entire economy wasn't that bad, even though the manufacturing sector was suffering a little bit because of reducing the stocks of things, which is over, as we know. So I think Germany could a little bit surprise to the upside in the next few quarters, at least stabilize, because also the property market gets stabilized right now.
That's fascinating. American analysts always say that their economy is uniquely sensitive to the property market, but of course that's not the case, as we're seeing here in Germany. Even in high rental markets, someone clearly owns the property, and so these effects matter. But what I wanted to pick up on now is another contrast between the US and Europe, which is the difference in debt dynamics. We've seen over the last few years an aggregate reduction in European debt levels, helped, of course, by higher inflation and the effect that has on nominal debt to GDP ratios. But in the US, we've seen continual fiscal expansion, with the federal debt staying over 120% and now growing again. And of course, that will have a read-through to bond issuance and bond prices and yields. So my question to you is, are you in the higher for longer interest rate camp?
Good question. I was in the camp of US dollar interest rates 3 years ago, going to 4 to 6%, which sounded crazy back then. Half a year ago, I had a presentation for the corporate sector in a symposium in the Tyrol in front of 600 treasurers and CFOs of Austria. And I was the only one in the panel who said the interest rates won't come down in the next year, which is half a year later quite feasible. But then it was quite against the common view. And I did make a call which did not open up completely right now, that the treasury rate for the 10-year yield bonds will go up above 5%. Because if higher for longer is, and this was the question, a topic, then it is not to expect that bond creditors will stay far beyond in inverted areas if the interest rate stays up. As I said earlier, I do not expect the kind of recession this year in the United States. The fiscal support is that amazingly strong, that retail sales are strong still. Consumer confidence is a little bit wobbly, but still not bad. And so I cannot imagine seeing that Asia is coming forward. Even China has to do something about its economy. And if that support comes into, the entire economy in the world will have a positive effect on that. So also the United States economy might have a positive effect on that. So the real problem for everybody and for the capital markets is, if I'm right and the yield for treasuries goes up that strongly, then something will break up possibly. So I do think I am in the area of higher for longer, because I don't see a kind of support for the Fed to lower the interest rates. And if that doesn't come, the yields have to go up. So that's possibly a burden.
That's one place our outlooks differ, at least in the near term. We think a recession, or at least a significant slowdown, is coming fairly soon, and that will require rates to fall in the short end of the curve and for the yield curve to normalize that way through the front end. But in your world, to get the yield curve to switch back to positive, you would need longer rates actually to rise. So is that correct on your outlook for the 10-year rate? Why don't you think 10-year yields should be going lower?
As long as we do not have a recession, there will be no one buying it. Because if you get 1% more in short-term rates without bearing risk, then for me, it makes no sense to buy a 10 yield curve. Mm-hmm. As long as there is no clear sign of a recession coming. The thing I would to point out, because I forgot it before, is the Fed is dealing with the yield curve. They lower QE a lot, from 60 billion to 25 only, starting in July. So the intention is not to put up more pressure on the yield, but to reduce it. So I think this might help for a while, but we do know that geopolitics is not supportive for foreigners to buy US debt anymore.
That leads me to one of my big questions for you, actually, which is that there is not much clarity on what very high US debt levels for a very long time will actually mean for the US economy and for rates. And there are two completely opposing views on this, which I think have yet to be fully resolved. One is that you get bond markets rebelling and spiking yields, which forces the government to deal with the debt levels, as they did in the UK when then Prime Minister Liz Truss tried to push through a large unfunded tax cut. The other scenario is that you get a Japan situation, or you get Europe in the 2010s, where there's a huge public debt overhang and it crowds out the private sector from the economy, basically, so that you need very low interest rates to help keep the public balance sheet from completely collapsing, and you struggle to get any private investment at all, really. So the key to that might be who actually holds the debt and how they behave, as you've hinted. Where do you stand on that debate?
It's always good to compare apples with apples. If you compare Japan with the United States, you have to realize that Japanese debt is only 5% in the hands of foreigners. If you look at the United States, it's around 25% in the past, and now lowering. You do have the opportunity to force internal forces to buy American bonds. So America is very rich, and you have your CalPERS and other pension fund systems. You can, by regulation, ask them with pressure to buy more of that stuff. So you can go on for that, but still not forever, because it's like Icarus. You may have heard the story from the Greek son of Daedalus, who tried to fly higher than his father recommended and burned his wings in the end and fell into the sea. The more you put up your debt levels, the higher is the interest you have to pay. And if it is for higher for longer, it will definitely go up from 35% of the tax receipts paid for interest rate only. In 2 years, in my view, there shall be the maximum pressure on the interest rate burden, and this shall reach today's tax receipt levels of 60 to 70%. And if then there would be a recession, which is highly probable if the yields stay elevated and higher for longer, and the yields for the treasuries too, then you have the problem the tax receipts go down while the interest rate pressure goes up. So there's a good chance that you might be right in the long term, that you can bring movement into the bond market, but short term, there's a big risk that something is blowing up, in my view.
Well, that's not a pretty picture. The natural response to your outlook for the rational investor might be, I need to go buy some gold. And that's part of the reason that we think gold can get to $3,000 and beyond. I think I might know the answer to this, but would you take the other side of that bet?
I'm not sure that I'm on the other side regarding the price development of gold. Pretty confident for gold prices, really. I share your view about medium or short term even price level of $3,000 an ounce is reasonable. US dollar in the last 2 years, after starting the war in the Ukraine, also went up, which normally also is a sign for a weaker gold price. So if we have a higher gold price under the pressure of burden that in history always pressured the gold price, and it's still higher, there's something bigger going on. And I think we both share the view that it's clear that central banks started to increase their gold buying a lot since the Ukrainian war. And this won't stop. This might even increase. Because of the geopolitics, China is reducing its US dollar reserves, as does, of course, Russia has it frozen and will not enlarge it ever. But there are still a lot more countries who are reluctant to buy European or American debt, and they are willing to buy more gold. And the gold price rose in the last year, although the private sector sold 300 tons in the ETF sector. So if the private sector comes back to gold due to some turmoil in the equity market or even and plus in the bond market, the gold price is still not elevated.
Okay, so we agree on gold. The only part, in fact, that we disagree on is that a near-term US slowdown, which we expect would be poised to give gold even a further tailwind.
I don't know who of us is the more skeptical for the future. You expect a recession. I say sometime in the future there might be a problem with the debt levels. Yeah. I think it both could come together. I think where we are not in the same area is the timing for it. I don't see it this year. You might expect it at the end of the year. But I think we're coming closer if we say, okay, if you're a little bit too early with your view, I'm a little bit perhaps postponed. We meet in the middle and there it is. I think in the end, reality is quite clear. It's challenging what we have as an environment. And we had terribly good times in the last 20 years. We're so happy. No, we're not. We are greedy. We want more of it. And this is not possible for the future forever. We'll have to have a pause.
Couldn't agree more. For my final question, Gerhard, I'd love to get your view on the global FX outlook. Where are you seeing value in global currencies, and what are your key tips?
I'm consulting corporates in Europe, as I discussed with you earlier. And I see that they do hard in realizing in which great environment they're working right now. Volatility in euro dollar, for example, is not even a third of what was common 10 to 40 years back. So we have a completely compressed volatility in forex markets. If you look to the euro dollar for the last 8 or 9 years, since 2015, the last bigger move, it's almost nothing that happens. If you make up a 50-year chart in euro dollar, the last 10 years are like smooth. Yeah. And before that, it was a roller coaster. The dollar went up 30%, went down 45%, went up 30%, went down 45%. In the long run, the dollar lost against the euro, backdated from 1970s. It halved. And the Swiss franc even went threefold against the US dollar in the last 5 decades. I think we see more divergence in the future. Also, the emerging market currencies are behaving like spring air, very smooth. This is not the case for the Turkish lira. It's not the case for the Argentinian peso, or for the Nigerian naira and the Egyptian pound, which are not normal economies. These are very unhealthy economies. They went too far in many respects. But if you look to the Australian dollar, the Canadian dollar, the movements are not strong anymore. And this, I think, will change. I don't know when it comes, but a recession time would be a good opportunity to expect more volatility also in this area. And if it comes back to the gold price, I think if there's kind of change in morale in the sector, it will even support gold much more. And I think 30,000 is not the end price of gold.
In emerging economies and small economies, is one reason for that commodity prices have been more stable in recent years? And could commodities trigger a bit more volatility going forward?
The commodity prices stabilized, it's true. They went up a little after the little turmoil we had after Corona. I'm pretty confident if I combine commodity prices and emerging market currencies for the Indonesian rupiah, for Brazilian real, and even also Mexican peso, because these economies also provide a real high real rate. So inflation is not even half of the interest rate, which is pretty much, and still the economies are evolving. Joblessness goes back, interest rates come down a little, and this shall support the currencies in the end because inflation is that low. And higher commodity prices, I wrote some books. One of that was 3 years ago. And I expected higher commodity prices due to two effects that are very, very strong and structural. The one is the turn in the energy support, that you see a global demand wave, which is a huge wave because everybody wants at the same time the same materials to electrify its energy supply. And this makes something very big moving, and it's about to start right now because the supply side of the mining sector is not prepared for that. They did not invest sufficiently. You know that from Canada much more, that the companies paid back debt and consolidated after the break in the prices 10 years ago. And to build up a copper mine takes 10 to 15 years. It wasn't done. So if demand picks up, commodity prices shall pick up too. And this is something I expect in the next 10 years to be supportive for emerging market countries who produce that stuff, and also is able to support their currencies in this respect. The second thing is the geopolitics, because we will have, perhaps you might think of a closing of the Strait of Hormuz by the Houthis and Iran. And there's a lot of stuff going on. If you look at Taiwan, a concern that many people have that something big is going on there, perhaps a war or whatever. We will face not less, but more geopolitical stress in the system that might lead to comparable spikes as we had it 2 years ago when it comes to demand side. And supply demand is not in a good position to fit.
Gerhard, it's been great speaking with you, and I think it's time to wrap. But before we do that, maybe I'll take a stab at summarizing your key messages. So firstly, interest rates to stay high, but Europe to start easing first and with the potential to deliver some outperformance. Just like us, you're very positive on gold. We're both very nervous on the US fiscal position and using to think it can cause big disruptions quite soon. And you like emerging markets with domestic strength and well-contained inflation. So that points to Mexico and some of the APAC countries. Does that capture it?
Yes, completely.
Thanks again for joining us on the Rosenberg Roundup, Gerhard, for what we'll call the view from Europe. It was a real pleasure getting your insight, and we hope you'll be back.
Thank you very much for having me, and have a good time. Thanks a lot.